The good, the bad, and the ugly. That's our topic on today's Backstage Pass. Well, good afternoon, everybody. Hope you've had a great Thursday today. Stocks are closing the day lower today. Mortgage bonds are down today as well. Mortgage bonds are down about 70 basis points at the time of recording. The 10-year yield is up about 10 basis points and trading at 4.22%. The national average for a 30-year fixed mortgage, well, that's coming in today at about 7.37%. As those 10-year yields are growing higher, we're seeing those mortgage rates kind of creeping higher along with it. And look, it's been a mixed bag as far as news today. We've got some real estate and housing news. We'll give that to you in just a second. But on the economic side, we saw the Philly Fed Business Index that came out this morning. That came out lower than expectations, which is good for inflation. It means that what the Fed is doing to tighten the economy is working, should eventually start to see inflation coming down. But on the flip side of that, we got initial jobless claims, and initial jobless claims came in lower than expected and lower than they were last week. And well, the mortgage bond market and bonds in general just didn't like that data, and so that's why we saw a reversal this morning. Bonds were only down about 10 basis points, and we've seen a pretty big dip since we got the news about jobless claims. Now, in housing news and real estate news, we got existing home sales data today. This report comes from the National Association of Realtors, and this existing home sales shows homes that have closed on existing contracts that have closed on existing homes. Throw some data up here so you can take a look at it and read along with me. Now, existing home sales showed that sales were down for September by 1.5% at a 4.71 million annualized pace. That was slightly stronger than expected, but still a decline. On a year-over-year basis, sales are down, let's say 24%. Now, on the inventory side of things, there's a 3.2 month supply of homes, which is tight because 6% or 6 months is considered balanced. But if you look at active listings, there are only 732 active listings, which means that 41% of the quote-unquote inventory in the existing home sales report is under contract already, and it's not truly available. Now, this speaks to demand because a normal market has about 25% of inventory under contract. When looking at the month supply of available homes for sale, so that 732,000 number, it's really about 1.9 months. And then the National Association of Realtors chief economist, Lawrence Yun, he came out and he described the difference between our current market and the bubble of 2008. And this is what he said. Despite weaker sales, multiple offers are still occurring with more than a quarter of homes selling above list price due to limited inventory. The current lack of supply underscores the vast contrast with the previous major market downturn from 2008 to 2010 when inventory levels were 4 times higher than they are today. So here's the good, the bad, and the ugly. First of all, we still have an inventory crunch right now. That's bad because it's making it difficult for people to find homes or find the property that they want that fit their budget or fit their affordability. But that's also supporting home prices. It's keeping home prices propped up, which is good. If we had 4 times the inventory right now that we have, we would be seeing a bubble. That would be bad. Now, why is the inventory crunch happening? What's going on? Well, part of it is because of rates and mortgage rates right now. Mortgage rates are kind of ugly right now, all right? People that own a home right now that have a 3% or a 4% mortgage rate, well, they don't want to sell that house and then get a new house with a higher rate at 7.37% like what it's coming in today. So that's part of the reason. But also, like we discussed earlier this week, yesterday and the day before, well, builders are slowing down construction. And so there's not as many new homes coming on the market as well. So sellers, existing homes, listings that are coming on the market, that's slowing down. Builders are slowing down. It's keeping inventory low. It's keeping home prices supported. And you know what the good news is? We're not going to see a bubble. We're not going to see a crash. And in just a few months, interest rates, mortgage rates are going to start coming back down. Within the next few months into early 2023, we're going to see mortgage rates coming back down. Now, that's all the news that we have for today. Don't forget to stay positive. Like, comment, and subscribe. If you have any questions, leave them in the comments. I'm sure to answer all those questions. Thank you so much. Have a great day, and we'll see you tomorrow.